So this is module 3 for the MBA 600 Intro Finance lectures. In order to get the most knowledge out of this module, it is essential that you have gone over module 1 and module 2, because this module starts from the end of module 2. So in here we're going to talk about break-even. What is break-even and why is it important? So what is break-even? Break-even is where the sales are exactly equal to the cost of running the business. What that means is that when the business gets to that point, and it is important, especially for a new project or a new business, because when you start out, there are more costs than sales or revenue, and then slowly the sales start to pick up, and eventually the sales will be equal to the cost, and that is when we say the business is breaking even, which means that it is providing enough money to support the cost. So the profit is exactly zero. This is the profit before taxes, EBT, that we talked before when we were talking income statement. Now, what does that mean? The good news is no taxes, because you are not making any money. So basically earnings before taxes is almost zero. The bad news is you did not make any money. But from a business perspective, the concept of break-even is important to understand, because what you want to do is to have a feel for your business, is to say, okay, how many donuts we'll have to sell before we get to that point we are at least covering our fixed costs. So that is the concept of break-even. In this module, I will start with the PowerPoint, go through the concepts, the formulas, the calculation, and then we'll go back to the Excel and see how we use Excel to do what-ifs with the break-even analysis. So again, we are going to eventually go back to this income statement that we started in the first two modules. And what we want to do is to figure out, as the quantity goes down, obviously we'll have less sales. Our product cost will be less too, because product cost, as we discussed, is a function of how many donuts we are making. So these both will come down. But these don't change because they are fixed. So the question is, how much lower can we make that number such that the earnings before taxes goes to zero right here, and at that point it is break-even. Okay, so let's first get into the concept, understand why, understand some basic numbers, and then we'll come back eventually, before we end the module, to this particular income statement, so we can figure out how would we calculate the break-even for our business right now as we have been working on. So break-even calculation. Step one is deciding with some good confidence what is the price we can charge, which means you basically start the analysis, and that's going to be the price. Now, for a donut shop, we have some prices, that led into the revenue. So typically in a business, you go through market and competitive analysis, and you come up with the price. At what price will customer come to your business and buy your coffee and your donuts and your cake? Step two is obviously looking at your business and figuring out what portion of the variable cost and what portion of the fixed cost to operate the business. And again, variable cost is cost directly related to each quantity we make, like the flour, the sugar, the frosting, the coffee. And the fixed cost typically stays fixed regardless of how much we make. And again, variable cost, any cost that is directly related to producing a product or providing a service, which means if the quantity is zero, which means if you're not making anything, there will be no variable cost, because we are not making anything, so we are not going to need any flour or sugar. Again, the fixed cost, regardless of the quantity, things like rent, utilities, they will be fixed, regardless of how many donuts we make, 1 donut or 1,000 donuts. Again, that's the fixed and variable. Same thing that we talked about in the module 2, where we did some analysis on the income statement. So let's take an example. Let's say a business only has one product. They sell one item and they sell it for $10. So the price per unit is $10. And let's say that the variable cost to make each one of them is $4. So in this example, each one is sold for 10 and each one variable cost is $4. And let's say to run the business, the total fixed cost, the utilities, the rent, insurance, everything adds up to $1,000. So now that we know what the unit price will be, we know what the variable cost will be, we'll know what the fixed cost will be. So the question is, how many will you as a business have to sell every month to break even, which means that you have to sell minimum of that many if you want to at least be at a 0 point. Anything above that will make you profit, anything below that you will lose money. So that's what we want to do, okay? So what is the break-even formula? The break-even formula basically is that we are looking at our total fixed cost in our business, and we are dividing it by price minus the unit variable cost. Basically, that is the margin, gross margin per unit. How much do we have, and how much fixed cost do we have to cover? So, price P is the price, FC is the total fixed cost, VC is the variable cost per unit, Q is the quantity. So in our example, if price is 10, variable cost was 4, fixed cost was 1,000 per month. If you put this in this formula, you will see we will need to sell a minimum of 167 units to be sold every month to break even, which means at this point we're not making any money, we're not losing any at 167. At 165, 164, we will be losing money. At 168, 169, 170, we will be making money. Higher the quantity, obviously more profit we'll make. Lower the quantity, we will lose money. So where does this comes in play? Break-even analysis. This provides a reality test based on markets and demographics. What do I mean by that? I mean, for example, let's say you're starting a business and you look at your cost. You went and did the analysis and say, in order for me to rent a place, I will need so much, utility, etc., etc. You have some estimate for the price, and you now have a feel for what it would be. Now, the comparative analysis that has to be brought in play is that in some ways it provides a reality test, which means that once you calculate that you have to sell at least, say, in our example, 167, and if in the market you are serving, if the market size, say, on total is only, say, 200, and there are 3 other competitors, and if you have to sell a minimum 167 to break even, then you know it's going to be a tough to be able to make business. It also based on the economic condition, and is this a necessity or a luxury item? For example, if you're selling something that is a luxury item, something that people can do without, then it would be hard to sell, so hence hard to sell many. So the break-even analysis, it becomes a foundation to be able to decide that in the area where we are supporting the competitors we have, what is happening to the economy, in this example, is 167 per month selling plausible or not? But let's say the market size was 10,000 and there are only 2 or 3 other competitors. Then yeah, selling 167 is very plausible. And again, if the market size is very small and there are many, many competitors, then 167 will be very, very difficult. So this is kind of, at least we know that at a price, we need to sell so many. Now, the other thing that is important is that we may think we can sell it for $10. What if you start your business, or what if you introduce your product and your competitors lower the price? And now, instead of $10, what if we have to lower the price? Now what happens? So let's do what if. So what if, when we start our business and competition drops their price and we have to drop our price by 10%? So instead of $10, we can sell it, we'll have to sell it at $9 versus the 10 that we had assumed, or what we were selling it for before we lowered the price. So at a lower price, obviously we'll have to sell more, because in order to cover costs, if you lower the price, we have to cover more. And then the question then becomes is, okay, how many more? And obviously you would expect the break even, which means the number of items you have to sell will go up. So we apply the formula again and say the P, with the P is 10, and with the quantity we calculate break even was 167. If we lower the price to 9 and apply the same formula, you're going to find that we have to sell 200 units to break even. If you have to further lower the price because maybe the economy is bad or there is more competition, then a Q quantity will required to break even is even higher. So the end goal is to see if the required Q is plausible, which means that if you look at your model and say, there is some chance I may have to lower the price, so you can do what if, and then decide, in the market you are serving, based on your market analysis, based on the demographics, based on other competitors, is selling 250 per month plausible or not? If it is not, then you cannot lower the price. But at the same time, if your competition is lowering the price, you may not have a choice. So break-even analysis gives you a good approach to kind of think through, what is the relationship between the price and the quantity, and how would you think this thing through. So we can also look at break-even analysis from a fixed cost perspective. Okay, because remember, in the calculation, we also have a fixed cost. Now, why is that important? Well, the reason that is important is that if we are doing a business where a fixed cost is 1,000, and the economy is bad, and what if we can either negotiate a lower rental from the landlord, or if we can move to a smaller place or less expensive place and be able to figure out the fixed cost to go down to 800. Now, lower the fixed cost, less quantity we need to cover it. So, for example, when we're doing the price of 10, and the fixed cost will be 800 compared to 1,000, and if you do the calculation, you will find that you only need 100 units compared to 167. And that's one of the reasons why when there are startup businesses, typically they start from the garage or the house because they want to keep this fixed cost to minimum, because lower the fixed cost, less they have to sell to break even. Now, if you are in this situation, and what you see in the parentheses is the fixed cost for 1,000, over here you see if the fixed cost would be 800. Now, if I change the price, at price of 10, which was a baseline, at $1,000 per month fixed cost, we have to sell at least 167. At 800, if I can find a way to lower my fixed cost, maybe less rental, less utilities, then I only need 100 to break even. Now, if we lower the price because of the competition to 9, and if our fixed cost would have been 1,000, we would have to sell 200 units. On the other hand, if a fixed cost would be 800, we only have to sell 120. Similarly, if we lower the price even more at 8, at 1,000 fixed cost, we would need to support 250, whereas at the 800, only 150. So now you see that there is a relationship between the price, the quantity, and the fixed cost. At least you can see that as you're looking at your business, you want to do is to feel comfortable. What is the break-even units you will need? And so this way you can kind of keep an eye on your fixed cost, and also to see at what price you're going to charge. And obviously you don't want to lower the price if you can charge a higher price, but at the same time, as a business, you should at least analyze it and be prepared to say, what if I have to lower the price? Now what happens? Okay. So in summary, before we go to the Excel spreadsheet, it is an important analysis in a business. It is simple to do. It's a very quick calculation, but it gives you information that is very, very useful by looking at your fixed cost, looking at your price, looking at your variable cost. Break-even allows you to provide the reality check. If we think we need to sell 150, 200, or whatever the product we're selling in a month or a year, is that plausible or not? If the numbers comes out that we have to sell 167 and the market size is only 200, that would be a very difficult thing to do, especially if there are other competitors. And it also helps us to do what ifs with the different price, with the different fixed costs, or even different variable costs, to say, what if I can buy it for a lower variable cost? How will that help me? Obviously, it is very easy to do with Excel, and that's what we're going to do next. But again, I just wanted to do is to at least have you understand the concept for the break-even analysis. And the next thing I'm going to do is to open an Excel file and talk about these things, but using the calculation, using the Excel file. So first I want to do is to talk about break-even with some simple numbers, and then we will go back to our income statement. Okay. So let me set this thing up for you. Let's say we have only one product, cake, and the price, let's say, is $10, and let's say our quantity is 300, in this example, so sales is 3,000. Sales is what? Sales is really, if I look at the formula again, it is going to be the quantity times the price. Now let's say variable cost to make a cake is $4. Okay, so total variable cost to make 300 cakes would be, obviously, cost per cake times the quantity, which is 300 times 4, the formula right here, you'll get 1,200. And let's say the fixed cost is 1,000 to run this business. Now, to see what is the earnings before interest and earnings before taxes is basically how would we do that? We take our sales, which is 3,000, which is B7, subtract from it our variable cost, which is B10, up here as you can see, subtract from it a fixed cost, which is B12, and we get a profit. So right now we're making a profit. Now in the PowerPoint I talked about the formula. So here is the basic formula. The basic formula is, if you want to start to do the calculation for break even, so the formula is the sales minus cost, both the variable cost and the fixed cost, subtract both of them, your profit is going to be 0, and that's a break even. And so if I look at this again, for sales is price times quantity, unit cost, and so on. Now from there we came up with the formula to say if I want to know the break even quantity at which the earnings before taxes is 0, the formula is we take the fixed cost and we divide it by the difference between the price and the unit variable cost. So we take this formula and put it over here. So what is the formula right here? The formula right here is B12, and what is B12? B12 is the fixed cost, which is what this is. Divided by parenthesis, so we can look at the difference between B5 and B9. What is B5? B5 is the unit price, and B9 is the variable cost. We plug it in, it comes out to be 166.67, or rounding it to 167, and that's what we had before in the PowerPoint. Similarly, we can also figure out, okay, so what if we think we can sell 300 because that's what we can make, but what if we have to lower the price? How much lower can we go before we are going to, be at the point of break even? So again, using the same formula, we reformat it, and again, you don't have to worry about reformatting yourself. It is, I'm doing it for you. The formula is you're going to take the fixed price plus the total variable cost, the total cost basically divided by the quantity. So look at the total quantity divided by Q, you get this thing. Now, in order to check to see how this formula is worked, let's first do this check to see what if I change the quantity instead of 300, what if it was 166.667? So 1666.667, and you will see the earnings before taxes is almost 0, which means that at that quantity, at that price of 10, I have to sell at least 167 to be able to break even. Now, if you go back and say, okay, what if we are not going to change the quantity, but what if we have to lower the price? Now, we calculated the formula, but let's see if we can test it out. If I go in and change the price to 7.333, and you'll see profit again very close to 0. So that's why it is easy to use Excel, because you can use this and change it and you can figure this stuff out. So let me kind of summarize it, and then we are going to go back to our income statement. So formula for break-even quantity, break-even price is right here. This is where they put in the Excel. So what you need is the price. You need to know your quantity. You need to know hence the total sales. You need to know unit variable cost, and hence the total variable cost and the fixed cost. And from there you'll be making some profit. As you change this, you can lower the price, and you will find that for this situation you can go as low as 7.33, and your profit will be close to 0 or slightly above. Below that is going to start to lose money. Or if you want to keep the price the same but change the quantity, you can go as low as this. So think this through. This is really important. It is not that complicated. I think if you think it through and kind of practice with it, you'll feel comfortable. So now let's go to how would we apply this to our income statement? So the thing that is now what we are going to think through is to say, whereas before in the prior example I said there is only one product. Now what if we have more than one product? We got donuts, we got coffees, we got cakes. In that case, how do we figure out what price to use? Do we use price of 1, 2, 10? So what you do is you come up with an average price. The average price basically is that if I look at my total revenue, in this case was 20,000, and I look at the quantity combined for all three, which is 16,500, what is the average price? The average price will comes out to be 1.212. So if I take 20,000 divided by this, I'll get 1.2.2. So that's the average price. So now that we have the average price, we need is the average variable cost. So our average variable cost will be basically your total cost of goods sold, and you are going to, right here, in order to figure out the average unit cost, you have to look at this thing right here, and you will see that the average total variable cost divided by the quantity. So each one is costing 0.661. Okay. So now our revenue is going to be the average price times the quantity. So you can see the formula over here. It's C7, which is the quantity, B9 is the price, we get this thing. The average cost is going to be C7, which is the quantity, times 0.60666, which is what we basically calculated over here. And so now we have our income statement tied to the quantity and the price, and the cost of goods sold tied to the quantity and the variable cost, and now we have this thing. Now, so we can do the same thing over here. We can go in and figure out what would the break-even quantity be. Same thing, formula from this right here. We did it again before. We can do the same thing over here. So basically what this means is this. If we want to keep our average quantity, if you want to keep the price to be at 1.2, on average price to be 1.212, we can lower the quantity to as low as 12.855, and this thing over here will be positive. And we'll check it out. We'll change the numbers. Or we can keep the quantity where it is, but change the price. So let's first go in and change the quantity. So let's say if I change the quantity to 12855, that's what we calculate the quantity has to be. So if I do that, you will see that our earnings before taxes, is 1, so it's almost a 0. So that means at this quantity, 12,855, if I lower the quantity, I will be basically at a break-even point. Now, on the other hand, we said, okay, we are not going to change the quantity, but we want to change the price. We can go as low as 1.0782 to see what happens. If I change the price to 1.0782, again, you see over here, the profit goes to close to 0. So now you see that the break-even can change based on the quantity or the price, and you can use the formula right here that we did, or you can use the Excel spreadsheet to do that. So let me kind of go over this thing one more time, because this may be a little overwhelming. So let's start again. I'm going to start from the first one, break-even one, the easier one. The break-even, we said, is the break-even quantity is a quantity at which the earnings before tax is 0. If I want to know break-even price, it is a price at which EBT is 0. The formula for break-even quantity is right here. Formula for break-even price is right here. Basically, I plugged it in here and here, the formulas, as you can see up here, and based on the price, the quantity, the unit variable cost, and the total fixed cost, it tells me that I can go as low as 167 on quantity, or if I leave the quantity alone at 300, I can go as low as 7.33 in price. Instead of 10, I'll break even. So that kind of gives us a range of where we can keep our business in. Now, if I take this concept and take it to a little bit, at our bakery income sheet level, Same formula, same logic. The only thing we had to do here was first figure out, because we have more than one items, we need a average price, which turned out to be 1.212. How do we do that? We took to the total revenue divided by the total quantity, and so the average price is 1.212. And it kind of makes sense because it is closer to the donuts, because majority of the quantity is donuts. So that's why the average is more here, because the quantity is much higher for the donuts that we are selling. So what this means, at a 1.212 price and this quantity, we will have, the profit we make. When we apply the formula for break-even quantity, just like we did on the last one, or break-even price, we can come up with that the break-even quantity will be 12,855, which means if I leave the average price alone, but change this quantity to 12,855, I will get to a break-even of earnings before tax equal to 0, and we can change that, and you will see that number will change. So I'll do it one more time. I'll go in, keep the price as is, change this to 12,855, and you will see that right here, basically the number goes to 1. So it confirms, obviously, that this formula is what it's telling you. Now, if I want to go back and leave the quantity alone, but change the price to what we have calculated, 1.0782, so I change that to 1.0782, and you will see again over here that this will change. So if I enter, and you'll see the profit goes to 0. So again, basically, we're using the Excel to be able to figure this thing out. So again, I hope this is helpful, and again, I will go over this in the class, but it's really important that you have at least listened to this thing once or twice, and it'll help you, comprehend the subject a little better. So again, this is the end of Module 3. In the Module 4, I will start balance sheet.